afternoon and a warm welcome to Nikhil Vadia. Please give him a big hand. So good afternoon, everybody. Let me first of all start by welcoming Mr. Vadia. I think this is the third or fourth session, right? Third. Okay. May I request my colleague Pratibha to welcome. Pratibha, yes, come and welcome Mr. Vadia with a bouquet of flowers. This is the time of the year when I used to be a salaried employee. The accounts guys used to threaten to not pay us any money because we have not done any investments. And that's the time they would manage to convince us that we should buy insurance products with money back. Okay, this was a long time ago and we used to be fooled year after year. So I'm so glad that we have someone like you who's going to explain not to make the mistakes that we did. So let me start by asking Devashish to formally introduce Mr. Vadia before we start.
Thank you, everyone, and welcome to another session on tax. This is part of our helpline, our tax helpline, which is free and supported by Capital First. All of you, please go and take advantage as long as it lasts, as long as the sponsorship lasts. Nikhil has over 20 years of experience in direct and indirect taxation, internal audit, and management consulting. He is, of course, a qualified chartered accountant and certified information systems auditor. He was first. He came first in Mumbai in June 2000 CISA exam, which is the second one. He has developed expertise in the areas of taxation, statutory audits, information technology, governance, and risk management. He has advised several leading companies in banking, manufacturing, financial services, mutual fund, retail, and merchandising sectors. He has served as senior manager with Aneja and Associates and heading their audit and consulting firm for 4 years when he attended to internal audits of NSDL, Paper Products, Crossroads Mall, and Cable Corporation, and so on. As a practicing chartered accountant, he's worked extensively with the Reliance Group, other multinationals. We are really proud and delighted that he's been associated with us as one of the very prolific experts in the tax helpline. Please do take advantage of the free helpline once again, and I welcome Nikhil to come and make his presentation today. Thank you.
Thanks for a very nice introduction. So it's March and everyone has to plan for what we have done for the entire year and what we have not and what we need to do. And what are some of the changes that you need to plan for the next year. So I have not covered the entire budget changes, only some of the important changes. So we'll just start this. So what are we discussing? We will discuss income from salary, what all we need to do if you have an income from salary, income from house property, if you have some rent income. There are some changes in this budget in the house property income, so we have included that. Capital gains, if you have sold any property, shares or anything in this year. Income from other sources, everyone has some income from bank FDs or bonds or bank interest, savings account bank interest, everyone has. Then some of the deductions from income, mainly ATC, ATD, ATCCB and ATCCD. ATC also I have included only few items which can be done immediately, which that doesn't take so much amount of time or planning, which you can do. And some tips for tax filing and some other issues, because of the demonetization and everything, people are receiving a lot of notices. So what needs to be done for those notices? And last but not the least is question and answers. I have not included income from business or profession here because that itself is a very big subject and it will take a huge amount of time. But if anyone has any specific questions on that, small questions can be asked here. If you have any big questions, you can take help of our helpline where you can ask. So let us start from income from salary. So if you have income from salary for this year, what all you need to start doing? First and foremost is for the period April to December, your employer must have deducted some tax from your salary. So take out your form 26AS from the income tax e-filing website, or nowadays all the banks are also offering a facility where you can plug in there and go to the income tax e-filing website to download the form 26AS. check with your pay slips, whatever tax has been deducted in the year, whether it is getting reflected in the Form 26 or yes or not. One thing is to invest to save tax. Other thing is whatever tax your employer has deducted, whether it is actually getting reflected in your 26 yes or not. Otherwise, at the end of the year, if something happens, some few things happening in the employer and they don't pay tax at all. So April to December, whatever tax is deducted by your employer would get reflected in Form 26 as. If it is not, you need to talk to your HR why it is not getting reflected. That is the first thing. Second, most of the big companies and nowadays small companies also, they give you a simulated tax computation. For many companies, they give it for Feb and March. Some of the companies give only for March. That simulated tax computation, whatever your investment declarations that you have submitted, whatever proofs that you have submitted, they give a saying that this is what you have submitted, this is what we have allowed. Because they have their own team who sits and scans through all your document, whether in case of an LIC policy or insurance policy or educational expenses or medical expenses, what all is allowed, what all is not allowed. So what you have submitted and what is allowed to you. Because at the end of the March, when you get your March salary, if you know that some of the things are not allowed to you and you cannot resubmit, you may have some additional proofs. You would have assumed that this investment would be allowed to me. Your employer says that this will not be allowed. So if you have some additional proofs, you can give additional proofs if they allow, or you can talk to them as to why it is not allowed. So this you need to check whether the simulated tax computation contains all the investments that you have made. It will also show the HRA. If you are claiming HRA deductions, it will also show the HRA deduction calculations, whether those have been done, whether your rent agreement is considered, not considered. Because in case of rent agreements, many companies have now become more stricter in terms of what all you need to submit, whether you have submitted proper documentation or not. So you can check this, whether that simulated tax computation is in line with what you assume that it should be there. Third one, which you need to check it, if you get any ESOPs during the year. In the simulated tax computation, it will contain under section 17.2, it will contain what is your perquisite valuation for ESOPs. In case of ESOPs, mostly the perquisite valuation is whatever you have exercised minus what is the market price. That would be treated as your perquisite value, and that value will get added to your salary. So you need to check whether that amount is correctly getting reflected, whether it actually reflects whatever ESOPs you have exercised during the year or not. Because these are two separate systems which works in any company. Your exercise of ESOPs is mainly handled by HR or legal or then, whereas the tax computation is handled by the payroll department or the tax department. So whether the information flow from your HR or legal has gone correctly to that or not, and whether the pricing is correct or not. So in case of large ESOPs, this issue may many times get created. So check for the ESOP calculations, whether those calculations have been correct or not. Next issue is nowadays what is happening, many Indian MNCs, they are issuing ESOPs of their foreign parent to the Indian employee. This is altogether a different thing. So the Indian Income Tax Act, though it applies, this SEBI regulation doesn't apply there. Now, in this case, you need to check the originally, and there are various kinds of ESOPs because every country has their own schemes. So you need to first know what is the scheme of that host country and what all is allowed as per the regulation of that country. There are many countries, they call it as RSUs, that is restricted share units. Many companies ESOP, then there is restricted share purchase plan. So they will buy the shares from you at a particular price. So there are a lot of different types of schemes, and many times the taxation of ESOPs will also depend on what kind of a scheme under which you are. So if you have received any ESOP from an MNC, you need to check that. First is to verify the calculation with the market price. Second important thing, if you have got an ESOP from a foreign, they will ask you to sign a lot of documents. And many times you will not know what all you have signed. Basically, they open 2 to 3 accounts of yours abroad, in a foreign country. One is the demat, like we have in India, demat account, your broking account and a bank account. Your shares usually get credited in your demat account. So important thing is when you file your ITR, you need to disclose all these accounts. It is a foreign asset, and Indian Income Tax Act now specifically requires you to disclose all your foreign assets. Even though you have paid tax on it, if you don't disclose this, it is considered as a very big non-disclosure. So please ensure that if you have any assets abroad, even a small bank account or some small shares, you need to disclose those shares there as to what exactly the account number, the details, which country it is, and all those things. Another thing is any dividend received abroad has to be declared as income in India. When you are allotted some shares, and if you still hold those shares, those companies in abroad, they usually declare dividend on a quarterly basis. So every quarter you must be getting some dividend. Many times this dividend is either credited in your Indian bank account or in your foreign bank account. There are some companies where you are automatically put under the dividend reinvestment plan. So whatever dividend is declared, they deduct tax on that, and the balance amount is again invested in the shares. But these two are separate events. Dividend received is a separate event, whereas the investment in share is a separate event. So the dividend received needs to be declared as an income. You need to pay tax in India. That is fully taxable in India. Based on which country those shares are or which companies those shares belong to, you can take the benefit of the double taxation avoidance agreement and take whatever tax is deducted there. You need to obtain the tax certificate of that country and claim that tax amount as a deduction here. So this is what you need to. Suppose those shares are sold. So you have got the shares, now you want to sell those shares. When those shares are sold, that capital gains is fully taxable in India. Usually if you held those Indian shares, if you held it for more than a year, there is no tax payable on that. But if the same shares you held it abroad, they are fully taxable. So whenever you sell those shares, and whether you bring that money back to India or not, if the money is still lying there, since you are in all these cases, I am assuming that you are a resident taxpayer of India. If you are a non-resident, then it's totally different, but I am assuming that you all are resident taxpayers. So in case of resident taxpayers, the capital gains is also fully taxable in India. It will be treated like a unlisted shares. So whatever treatment is given to unlisted shares, this would be given here. So if you have ESOPs from an MNC of a company which is listed abroad, you need to take care of this. This is now a new prevalent thing. This is one where 99% of the people miss out, and this I have seen every year. We get huge number of cases. Many times people don't even file their return after we tell them that so much tax is payable. In case you have done multiple jobs during the year, 99% of the cases we find that the tax, when we compute that tax, some tax becomes payable. Why? Actually it is very simple, but not, I guess people understand. First you need to check before March, check whether your last employer has considered all salaries received during the entire year. So if you have 2 jobs during the year, say for April to August you had 1 job, and from September to March you had another job. So the person who is going to give you March salary has to consider the salary for the entire year of April to March and deduct tax accordingly. Many salaried employees are not very comfortable giving the Form 16 of the previous employer or the salary details of the previous employer to the new employer. In that case, you need to separately compute the salary and see what is the tax payable. There are 2 options. One option, you ask your new employers or the employer who is going to give you the March salary to deduct that much additional tax. So you compute your tax in Feb and tell him that based on my salary, this is the additional tax you need to deduct. Second, you can pay advance tax on your own. So income tax allows you to pay advance tax. You compute the advance tax and pay the advance tax on your own. The issue with payment of advance tax is that then you need to pay advance tax installment wise. So the first installment was in June, second was in September, then December, and 15th March is the last installment. You can still pay up to 31st March with some interest. Though you will be paying the entire tax in March, the June, September and the December installment, you would be still liable to pay tax. That is the interest amount. Ideal option is to go to your employer, ask him to deduct the tax. Why this happens? Say for example, if the salary is received from employer 1 is 5 lakhs and employer 2 is 4.5 lakhs, tax needs to be paid on 9.5 lakhs. Now if you have first 6 months salary as 5 lakhs or say 7 months salary as 5 lakhs, next 5 months salary as 4.5 lakhs, if both the employer considers the basic slab as well as they consider the entire ATC deduction, it is quite possible that on an entire 9.5 lakh they have not deducted any tax. Now when you combine the entire salary 9.5 lakh and calculate tax, the tax may come to around 50,000 to 60,000 rupees. Now same person comes to us in say July and say that you compute my tax. I tell him that your tax is 60,000. His almost salary is 60,000 a month. So it becomes almost impossible for him to pay that tax at one go in June or July. So even if you have changed the jobs, please ensure that you pay the tax now before 15th of March as advance tax, or in other cases you ask your employer to deduct additional tax. You compute the tax and you ask your employer to deduct additional tax accordingly. So this is income from salary. There is one more few things we'll discuss. What happens if you have submitted some declarations or investments and your employer has not considered it, or you have submitted but you have the investment but you have missed the deadline. This happens when people are not people are quite busy, or they were not aware about the deadline, or they have missed actually the deadline for submission. You can still claim, but not everything can be claimed. Something like an LTA or a medical bills, that cannot be claimed. Your ATC deductions you can still claim. Your HRA deduction you can still claim. These are the major deductions which I am talking about. So those can still be claimed. But please remember, there is an internal guideline, though this is not official. If the difference is more than 10% in the taxable salary as per Form 16 and income tax return, then you can expect an inquiry from the tax department. This is not officially written anywhere in income tax. The internal guidelines, whenever the CPC is processing, those kind of cases are selected. But they assume that either you are claiming something wrong, since the employer has not considered, say for example, HRA benefit, and you are considering now, or employer has not considered ATC benefit, you are considering now. So there is a difference in the income which the employer reports as per Form 16 and what you are filing. And if you file ITR 1, it gives you only one amount, what you have to fill in. It doesn't give you the breakup how you have calculated. Whereas your Form 16 has the calculation, but that you are not attaching with your return of income. And there is nothing in ITR 1 or any other form where you can give an explanation at the time of filing the return, saying that my employer has calculated this, he has not considered my, saying so my salary is this. There is no such option. So you will file it online, they will match it, and they will ask you a question why you have not done like this. So if the difference is more than 10%, it is quite likely that they will ask for an inquiry. This is what the budget has changed this year. TDS at the rate of 5% on rent payment of rupees 50,000 or more per month. Now when it was initially reported, it was said that you have to deduct only in March. The actual law which says that on the last day of vacating the tenancy or last month of the year, whichever is earlier. So you have 11 months agreement. So mostly those agreement will break in the middle of the year. So you have to deduct tax. If you are paying more than 50,000 a month rent, then you have to deduct tax twice. Once your first agreement got over, even if you are continuing with the same person and if you are executing the new agreement, I would suggest that you deduct tax twice and pay. Second important thing is you have to deduct tax every month. It's not that you have to deduct tax only in March. Ideally, you should deduct every month and then pay it in March. Because if you don't pay anything to that person in March, it will create problem. And he may also not agree. So you have to deduct tax every month and then either pay on the last day of that vacating the tenancy or on March, whichever is earlier. So this is the new thing which has come from this year onwards. In case you own more than one premises, then you need to, like, this is not usually followed, but nowadays they have been very strict with this rule. Anyone who owns more than one house, the one house at your option is treated as as self-occupied. The second house onwards, it is treated as deemed let out. I don't think most people were not paying tax on this, but they have become very strict, and now for last 7-8 years they have all the data from the AR info at what houses you have purchased and what houses you have sold. So it's advisable, if you own more than one house, you start paying rent on the other house. Even if it is not on rent, you are supposed to pay tax on the deemed rent. Now what is deemed rent? Deemed rent is the rent which the property is likely to fetch in the market. So there are different municipal valuation as per the Rent Control Act or likely rent. Usually nowadays officers, when you go to and talk to them, they go to these sites like Magic Bricks and other sites. They calculate the rent, approximate rent from there. This is the rent I am considering. So you need to consider that rent and pay. Second, if you have actually let out many houses and if you have more than one house property, and the other person is either deducting tax or he is not deducting tax. Even if he is deducting the tax, he would be deducting only at 10%. Whereas if you are under a little higher slab, then you will be either under a 20% slab or a 30% slab. So the balance 20%, you need to calculate the advance tax and pay before March. Ideally, you should pay all the 4 installments, that is June, September, December and March. But even if you have not done it, you should pay the installments by 15th of March. You will at least avoid interest under 234B. Now, this is the last thing which I think nobody is following, I would say. In case you are paying rent to an NRI landlord, you need to deduct tax at the rate of 30%. Even if you are, and there is no basic exemption here. So even if you are paying 1 lakh a year rent to an NRI, the tax is that 1,80,000 rent limit for it is only under section 194I, and that is only for when you are paying to an Indian resident. If you are paying a rent to an NRI, you need to deduct tax at the rate of 30.9%. If you are, and it becomes more serious if you are claiming HRA benefit. They may come up and say that I will not give you the HRA benefit since you have not deducted the tax. So whenever you are dealing with an NRI, please, an NRI landlord, how would you identify? That is very difficult, but whenever you are hiring, taking any house property on rent, you need to ask. You see, most of the rent agreements, the way they are made now, there is a standard rent agreement available on the net or with the broker. Download, you change the names and addresses, but it contains 2-3 important lines. I am so-and-so, aged so-and-so, resident of so-and-so, residing at so-and-so. That word resident is very important there. Though we don't apply our, we are in a hurry, so we don't read the entire agreement. He is declaring that he is a resident. So the NRI will also not know that I am a NRI, so he will not say that no, I will write that I am a non-resident. And whether that resident written there is from the point of view of income tax or it's some other point of view, no one knows. So people just say that, okay, I am a resident of so-and-so. And they go ahead and execute the rent agreement.
So a signed agreement where the landlord is represented as himself as resident, there is no excuse.
No excuse. So this is another thing.
TDS deduction is for more than 15,000 rent paid in excess of 15,000 or any amount.
Any amount.
Okay, thanks.
Any amount.
Non-NRIs as well?
No, only for, see, that 50,000 per month is for people who are not covered under tax audit. So like individuals, you and me. Those who are covered under tax audit, there is a separate provisions for them, 50,000. What I have talked about 30.9% when the landlord is NRI. Please also remember when there are joint owners, even if one of the landlord is an NRI, for rent payment to him, you need to deduct the tax. So if there are 3 joint owners, 3 brothers, sisters, whatever, one of them is an NRI, for his rent payment that 195 apply. For other 2, normal provisions will apply because they are 3 co-owners. So you need to remember that also.
So I pay out rent to my parents. So what's the limit? What is the limit suggested to pay out rent? In the sense, if I pay out 45,000, this is purely for basically saving money for tax from taxation. So and of course I do transfer the money to my mother's account as well. So
is she filing her tax return?
Yes, she
showing
is.
that income?
Since the time I'm paying tax to her, she's returning tax as well, paying IT returns as well. So I just wanted to understand, so is there any limit to that?
50,000 is the limit. If you are paying more than 50,000, you will need to start deducting tax.
And the only thing is that she has to show it in returns.
She has to show it in
proper.
Now whether it should be allowed or not allowed, it's a different concept altogether.
Yeah.
And if you remember, if you are regular with Moneylife, there was a separate issue of Moneylife only on this HRA and rent, what is to be done, in case they are co-owners, what is to be done, how to pay, what is to be done, and all those things. Raj Pradhan has done a special thing only on that. So you can refer to that.
It's available online?
Yeah, it is available online.
Thank you.
In one of the previous sessions at Moneylife, it was mentioned that, this 50,000 rupees per month or part thereof, they were specifically referring to, taking on rent a hall for a marriage or something. So I want your opinion on that. with respect to deduction of tax.
New provision which has come up.
Right.
See, in case of a hall, if you are an individual and if you are paying, it is 50,000 per month or past thereof. Yes, you can make that interpretation.
But that is only March.
That comes next year.
See what it says. As I've said, if we go to the back to it, said per month on the last day of the vacating the tenancy or last month of the year. So in case of a hall, you would have vacated on the same day. So next day you have to pay.
Person of Indian origin having a house in USA as well as in Bombay. So how it will be? He's a person of Indian origin. He's staying most of the time in USA, but he has a house in Gujarat also. So what will be the?
So for you're talking in terms of what?
Pardon?
You're talking in terms of what?
In case of deemed rent.
No, only houses in India.
No, but he's a PIO, person of Indian origin.
But that is okay. For the tax purpose, he will be a non-resident.
No.
If he's staying outside India.
No, but that second house will be considered as a Gujarat house. So he has to pay a deemed rent on that.
No, he doesn't have to pay a deemed rent.
No, because he has one house in US.
US also, yeah, I understand. But you have to consider both the houses in India. If you have two houses in India.
Okay, both houses in.
Yeah.
I've got multiple sources of income. So for when I had to pay the first installment on 15th of June, I saw that the 25% has been paid by the TDS deducted so far. So I did not pay advance tax.
No, see, for the calculation of advance tax, there is a separate section in income tax. You have to consider the estimated income for the entire year and that installment ka whatever is the percentage, whether 15, 45, 75, that percentage you have to pay. So it is not your April to June income you are paying by 15th of June. It's not like that. Or that your April to September you have to pay by 15th of September. Advance tax calculation says you have to estimate your income for the entire year, whatever is the tax on that, and 15% of that you are supposed to pay by June. So it's not quarterly income and quarterly tax. It is yearly estimated income and quarterly tax.
Less TDS up to that period.
You can consider TDS what would be deducted for the entire year also. So when you compute your tax, you can say that entire year income would be 5 lakhs. Tax, say tax is 5 lakhs. Tax deducted by various people would be 4 lakhs. So that 1 lakh ke upar, that percentages have to pay.
If you're deducting TDS as an individual, then you have to apply for a TAN number?
No, this section specifically provides that you don't have to apply for the TAN number.
So you just deposit the tax as a regular?
They will, the form has still not come. They will specify a separate form for that and how to pay. So this provision is not even yet passed by the government. It is just proposed in the current budget. So once this provision is passed, the rules will come, the forms will come. How do you generate the to form 16 or any other form which they will specify, and how will you give it to the person to whom you have deducted the tax? So that will also come. So those rules and will come afterwards. Yeah. So we were on now. In case of co-owners, the other thing which needs to be remembered specifically is that rent is to be included in the respective owners based on their contribution at the time of buying the house. Many times if there are 3 co-owners, we usually assume that the rate is 33. Or if there are 2 co-owners, the rate is 50%, 50%. I have seen cases where there were 2 co-owners, one has contributed only 5%, another one is 95%. When they sell the house or when they were trying to sell the house, the other person said, "No, 2 co-owners hai, I'll pay only 50%. I will not pay in any other percentage." So in case of large transactions also, people say that if to 2 co-owners it is 50-50. It's not like that. It is based on the contribution that the person has made during the purchase of the house. So that needs to be remembered. Second, from 2016-17 onwards, in case of if you have income from house property and you wanted to claim the interest deduction, you are given 3 years to complete the house. Now it has changed to 5 years. So that is one good thing. But they have changed here from 3 to 5. We will go to capital gains, and the section 54, that limit is still 3 years. So here the limit is increased, there the limit is not increased. So that anomaly still remains if you are claiming exemption under capital gains. Another change which has happened from 2016-17 onwards, arrears of rent. Previously there were little complicated calculations under section 25, 25AA and all. Now simple section 25A has come. Said any unrealized rent or arrears of rent. So if you are negotiating with somebody, or if you have given your rent premises on rent to some PSU, government, or some big company where you are negotiating with them, and during the period of negotiation they have given you some rent which you have offered for taxation, because the arrear is not still finalized. When you get that arrear, that they've said it will be taxable in the year in which you get that arrear. So that is one thing. Second, it is also specified, suppose by the time you've sold the house, so you are still negotiating and you're sold the house. So it is specifically provided that even if you are not the owner of that property during that period, you are still supposed to pay the tax on arrears of rent. This is the change which has come, major change. 2017-18 onwards, loss of house property income is restricted to rupees 2 lakh per year, even for a let out property which was unlimited earlier. So this was basically plug the loophole. Many people were using this for a tax planning purposes. People used to buy second house, third house, fourth house. The dim rent yielded, see the issue here was the rent yield was very, very small. So rent yield in case of a residential house was, we say 1%, 2%, 3%. You are paying 8% rent. You are paying 8% to a housing company. To balance 6%, you can get set off against your other income. So people were buying houses. Now this will create a major issue for them. That, and the other issue which has come up now is this change which is made in section 71. That is intra-head set off. So this 2 lakh is for all the properties put together. It is not per property 2 lakhs. As I read it, because the budget has just come and I have read it, the change is just come in section 71. Section 71 is intra-head set off. So intra-head set off means you calculate the income under each head, and then a loss of which head can be set off against which head. So the entire income of that head. And there they have said, added a proviso which says that the loss which can be set off of house property against some other income, say salary or business profession, is 2 lakh rupees. So it is all the properties put together. So if you have 3 properties, 4 properties and lakhs of rupees of interest, now it gets restricted only to 2 lakh rupees. They have been nice enough. They said carry forward of excess loss is allowed for 8 years. But then 8 into 2, 16 lakhs is you will get maximum. And every year you have a 10-year housing loan, every year you will be paying more than 2 lakhs. So only during the last few years, whatever you have paid, that will get carry forward. Because on the 8th year, 9th year, the first year loss will lapse. So this is another issue which people will have. Another change which has come in this budget is for builders and developers. From 2017-18 onwards, income tax will have to be paid on the dim rent for completed houses after 1 year. There was a big controversy. Many of the decisions were in favor of the builders, 1 or 2 were against also. What the income tax officer used to say, that if you have completed the house, if the builder has completed the house, then it is a house property. So if you own more than one house, every builder will have more than one house completed. So since you own more than one house, you pay tax on the dim rent of that house. And some of the decisions of the tribunal were in favor of the builders, saying that no, this is my business asset, so it cannot be considered under house property income. Now they have said this time that this is to help the builders. So actually, if you read the budget, it said to help the builders to bring certainty to the law. We are doing this, saying that from if you have completed the house, from the completion date of the completion certificate, 1 year you are given to sell it. Afterwards, you have to start paying rent. So now it is specifically provided. Yes.
House, please, when the occupation certificate.
Just wait for the mic, please. Wait for the mic. We are recording it, that's why you requested to wait.
Complete house means occupation certificate or the completion of the building certificate, BCC, building completion certificate.
So
because most of the houses, residential have the occupation certificate, but they still not have received the building completion.
I think that is a major problem in Mumbai, where you have only OC.
Yeah.
And once you have an OC, everyone starts occupying.
Yeah.
And nobody bothers to get that building completion certificate.
Yeah.
So they have used the word house should be completed, whether it should be OC or BC or in some other state something else. This provision has just come 1 month back, so people have started thinking what is to be done. But yes, this issue has already been raised, saying that either this needs to be changed, otherwise people will not obtain, as such, builders are not obtaining building completion certificate. If they get benefit under this, they will, as such, will never obtain. So this is one more excuse for them to not to obtain building completion certificates.
Yeah, in advanced tax calculation, normally people can estimate what they will have at the end of the year. But suppose you have income from trading, say share trading, then you could have a profit and it could go into loss with options and all. So you'll have to calculate on quarterly basis.
There is no such provision in income tax.
Okay.
You have to estimate for the entire year. If there is any shortfall, you have to pay interest. Only thing, in case of capital gains, okay, there is a separate provision where you will not lose. We will discuss when we come to capital gains that there is an exception made for capital gains. So we'll discuss that when we come to capital gains.
Or you get refunds.
Or you get refunds, huh? But you will not be getting interest.
Hi. How do we calculate, take into consideration a scenario where one is living with their parents and paying HRA, a rent to them, and simultaneously they also own couple of properties on which they are earning rent?
This is all fact-based. We have to see each case separately, what is to be done, because where you are owning, where you are on rent, where you are working, it all depends on that. There is no clear-cut, straightforward answer to this, saying that if you do this, this is like. It depends on facts of the case. Many of the, see, in case of genuine cases like government employees who have transferable jobs, they may own a house property in their native place as their retirement or something, and they keep on having a rented places, various places. So they are allowed. So it's a very genuine case, and the Act also provides if you have to stay at some other place due to your employment, you are supposed to pay. But if you say you own one flat in Andheri, another in Villeparle, and then say I am not occupying this I am giving on rent, it's very difficult to explain.
So I have a case over here. I work in Dadar. The place where I live is in Parel, very close to the place of my work, and the properties owned are somewhere in Powai or something like that. Would that be a case?
It's very difficult to explain such cases. It's very difficult.
Thank you.
So we'll go to the capital gains. We've not missed out anything. Okay. We'll go to the capital gains. Capital gains as such are quite a complicated topic. I have tried to cover it under 3-4 slides, only basics. If you have any specific questions, we'll take those questions. For any assets sold during the year, if you have sold in the middle of the year or end of the year at whatever point of time, pay advance tax. You have to calculate the advance tax, whatever is payable, you have to pay. This section specifically, section 234C, which is for the interest on advance tax, specifically provides, they say you have sold a big property in October, and there is a huge capital gain tax and you want to pay that actual tax. Now you have missed the 2 installments earlier. So what is to be done? So the Act provides that if you pay the balance advance tax in the remaining installments, then you will not be charged with the interest of the earlier installments. So the question that you had said, there is this section also, so we are on capital gain. This 234C also provides if you have some one-time income, like lottery income or something which comes only one time. There also it has been provided as an exception. The month in which you incur the installment after that, and after that if you pay entire advance tax, then the previous installment you did not pay any tax. Interest, sorry. Another thing you need to check, if you have capital gains, the buyer would have deducted 1% tax. You need to check from your form 16, form 26AS from the income tax filing website that 1% appear or not. You have to obtain form 16B from the buyer. If you want to invest somewhere, time limit for investing in capital gain bond is 6 months from the date of sale. And for depositing in the capital gains account is for 31st July for individuals. I am assuming that you are not under tax audit. So it is 31st July for the individuals. And capital gains, please remember, now the limit is only 50 lakhs. Previously, people used to buy one capital gain bond of 50 lakhs in March, another one in April, and take this entire limit to 1 crore. Then there were decisions which were in favor of the SSE, so people used to do it. Now it has been stopped. He said against one capital gain, you can buy this only once. So that is now plugged. Yes, sir.
suppose if I sell the property in March, so I'll have 6 months to decide whether I have to invest or, so it will be later than 31st July. That will be just 4 months.
Correct.
So I wasted 2 months period.
Then you have to take a call. By 31st of July, you have to take a call whether you are going to. And usually during the first 6 months of the year, the capital gain bonds are many times not available. So, so capital gain bonds, that is another issue, because these issues are available, sometimes not available.
So what I have to file in the return if I sell on the same March 15th, in the first, by 31st March, I have to.
So before filing the return, you have to take a call whether you will invest in bond, or if you have actually invested, then only you can claim in the return.
Okay.
So income tax return cannot be based on the estimation of what we are going to do. It is on the basis of what we have actually done. So before filing the return, you have to take a call whether you will go for bond or you will go for the capital gains account. It cannot be afterwards.
Supposing one receives an advance from sale of property, the agreement is still not registered, but you get an advance. Can one buy another property?
Yes.
And then, but it can be set off against capital gains?
Yes, I'm just discussing that. There are two important sections in capital gain, section 54 and 54F. If you were to remember it very simply, I would say 54 is house against house. 54F is any other property against house. So if you are selling a house, you want to claim capital gains exemption, 54 is for you. If you have sold any other asset and you, and if you want to claim the exemption, the section 54F is the section for you. What can be claimed? Remember 1, 2, 3. Everyone remembers that? 1 year prior, if you have bought any house, it can be claimed as an exemption. 2 years, you have to buy a completed house, or within 3 years, you have to complete the construction. So if you remember 1, 2, 3, 1 year prior, 2 years afterwards, and 3 years for construction. As I have said, there they have changed section 24, they have changed the time limit to 5 years. Here it still stands at 3 years. Another thing, important thing to remember, for section 54, you need to invest the capital gain. So if you are going house against house, you have to calculate the capital gain, and that capital gain needs to be invested. In case of section 54F, you have to invest this entire sale consideration. Sale consideration minus the cost of sale. If you have paid some brokerage or something of that sort, when you sell, the brokerage is the only expense that you incur. Most of the expenses are incurred by the buyer. So minus entire sale consideration you have to. Another thing, when people claim 54F and they don't actually look at it, once you claim under section 54F, for next 1 year you cannot buy another house, otherwise that exemption is gone. And 3 years you cannot construct another house.
Even jointly?
Even jointly. So if you have claimed under 54F, and 54F has another condition that you should not be owning more than one house. So when you claim under 54F, it can be your second house, it cannot be your third house. So there are a lot of restriction under section 54F. Again, when you are buying a property from an NRI, this is very important. One of the joint owners may be an NRI. Okay. In case of buying from an NRI, you need to deduct tax at the rate of 30.9% and not 1%. This is very important. If you miss, then the liability, if you buy 1 crore house and you missed to 29%, the entire liability would be on you. So it is huge number. NRI can go and obtain a lower tax deduction certificate from his jurisdictional officer. So he can go show him the agreement saying that this is the MOU, this is the agreement I'm going to enter, this is my tax computation, based on that this is the tax amount, so you can ask the buyer to deduct at a lower rate. It can be from 30% to 0, any percentage. Many times you get at 3%, 3.8%, 4.2%. This kind of rates we get when we go for 197. So it can be any rate, but the NRI has to obtain. Another very important thing, if you are buying a house from an NRI, you need to obtain a TAN number and pay the tax in normal TDS challan and file the return in form 27Q. That 26QB form, which is there when you buy a property, the TDS on sale of property, everybody uses form 26QB. For buying from NRI, 26QB is not to be used. For buying from NRI, you have to use form 27Q, and that is a TDS return, like we file salary return. Those who are aware about TDS filing will know. For salary return, we file 24Q. For others, we'll file to 26Q. For NRI, you need to file from 27Q. So whenever you buy from an NRI, these mistakes many people do. They don't deduct tax at 30%, only at 1%. Then when they file form 26QB, if the department knows that he's an NRI, you get a notice saying that you have to pay the balance amount. So please remember this if you are buying from an NRI. Capital gains, few more things which have come up now. Holding period for land, building, or both has been reduced from 3 years to 2 years to consider it to be a long-term capital gain. So now for a long-term capital gain, you have 3 limits: 1 year for shares, 2 years for this, and 3 years for other assets. Why? No one knows, but it is there. Another thing which has come in this budget is long-term gain on sale of shares would be exempt only if the STT is paid at the time of purchase. When this budget came, there was a lot of controversy as what all would be considered. They've clarified that whatever you've got, bonus shares, right shares, IPO shares, preferential allotment, all would be covered. But if you are buying off-market, that would not get covered. So I think off-market buying of shares will stop, has to stop after this if you want to claim the long-term capital gain exemption. Another change was two changes which came in the budget. One in budget 2016 and another is in this budget. When mutual funds are amalgamating any schemes, now if the scheme is having very low AUM and they want to amalgamate, initially it was that the tax is payable. So last budget it came that in case of amalgamation of a scheme with the same mutual fund, the tax is not payable. Then the other question which was asked, what will be the holding period? So if one scheme is amalgamated into another scheme, they usually consider it as a switch in, switch out, or they consider that scheme as a redemption and this scheme as a new purchase. So now it has been clarified in this budget that it will be date from the original scheme, not from the date of the new switch in, switch out. So you get the additional benefit from this. Applicable for both debt and equity schemes.
Yeah, fine, thank you.
Another change which has come in this budget is base year for capital gains has been shifted from 1981 to 2001 for capital gains in 2017-18 onwards. If we are planning to sell a big property like a house or something, it is better to not to sell in March. If it is an old property, it is not better to sell it not in March but in April. So you get that 20-year benefit. In some cases, it can be a huge benefit. Another controversy which we used to always come, and there were thousands of case laws on this, was you can say partially put to rest by this CBDT circular of 29th of February 2016, which is a very recent. If assessee, when you are dealing in shares quite often, you are doing very often shares buy and purchases, whether it should be treated as a business or should it be treated as a capital gain. What used to happen is that the assessee and the assessing officer, that is the income tax officer, used to look at their own benefits. So assessees in some years will say this is capital gains, some year it will say it is a loss. So it's a business loss. So you will say one year you will say.
So I have a point. Suppose my income from salary is 10 lakhs and suppose share market in share trading, future option, incurred a loss of 5 lakhs. Then what is this tax liability on which income I shall calculate?
So business loss against salary income you can
Yes. Okay.
One of the issues was whether the entity has any other kind of income to determine whether it should be a business income or not. I'm just giving an example. Suppose there is a company which has got nothing else, only holdings. Even though the holdings have been there for many years, because there is no other revenue, therefore the income from any sale of shares, even though it's long term, has been treated in some cases as a business income. Because your business itself is holding shares. So is that set to rest now with this?
Yeah. What they are saying basically, first, if the assessee treats the shares as stock in trade, it will be business income. So the first option is to the assessee, it will be a business income. If the listed shares are held for more than a year, and if the assessee treats it as a long-term capital gain, then a assessing officer should not question it. This cannot be changed by the assessee later on. So 1 year you cannot say I'm in the business of shares, where because of the stock prices have gone down, on the stock you will incur some loss, so you will say I will set off. Next year the share prices have gone up and you have sold something, so now you will say that stock I have converted into investment, so I don't want to pay tax, so I have claimed the loss. Now when the income has come, I don't want to. Now when the income has come, I want to say that it's a long-term capital gain income. So that they are saying will not allow. But other cases they are saying if the usually they are saying if the assessee says it's capital gain, especially for individual cases, they are saying it's capital gain. They are saying you assume it to be capital gain and go ahead, because there is a lot of controversy, lot of case laws. What is capital gain? What is not capital gain? So put to rest because of this circular, hopefully. Anything on capital gains? We are moving to other sources.
There is also something that an SSE can keep 2 books of account, one for trading and one for capital gain. Two sets of stock and trade and capital gain.
Yeah, that is an old circular which says that you can have 2 demat accounts. One where you will say this is investment, this is capital gains. This is investment and this is business.
Short term.
That still continues.
It still continues. It cannot be again treated, the AO cannot object and say that I treated.
You have to be, see, the main thing in this circular, I have just simplified it in 2 bullets. It's quite a little bit big, longer circular. It says that the option is given to the assessee, but you should be consistent to what you are saying. Don't change your stand year to year based on whether it benefits you or not. So if you are consistent enough, even the court ruling which have come into tribunal ruling or whatever cases have come, always said that if you are consistent with what you are saying, it is up to you are right. The assessing officer will not question you.
Yeah, one question. This capital gains, it also covers any accounts abroad as well, right? That you mentioned in the start. So everything Indian and abroad. Okay.
Suppose if I have sold the property and I put in a capital account that I will buy within 2 years, and if I am not able to buy it for some reasons, what will be my tax liability after 2 years?
So whatever you are not able to invest, that would be treated as your income. So that capital gain scheme specifically provides. If you go through section 54 or 54F, it specifically says that if you are not able to invest or if you are not able to do anything with those amount, then you have to treat it as an income.
It will be treated as income at 30%.
Yes, higher.
That will be too much.
So we'll move to income from other sources. Interest on saving account. Now this saving account interest, there were some people were saying that this 10,000 rupees limit is per account. It is not per account. It is the cumulative of all the accounts put together. So if you have 4, 5, 6 savings account, all the savings account put together, the limit is 10,000 rupees, and not only for one account. So you need to remember that. Combined for including dormant account or non-operative account, if there is some interest credited because of that, you have to include it. Second is fixed deposit interest. I think nobody is able to calculate how banks are calculating the fixed deposit interest and what they credit in the year. In case of income from other sources, you have an option whether you want to follow cash system of accounting or accrual system of accounting. But we recommend that you follow whatever your bank is following. As long as it is not there is no major change or major difference between your calculation and bank's calculation. Whatever bank has reported, if you want to report something additional, you can report, because if some places you may have got less interest and the bank has not deducted any tax. So those you can remove. Previously there was a loophole which many people used to use. Because of that, the interest in fixed deposit was much higher than reported in 26 AS. The loophole was that the fixed deposits were treated per branch. So people used to go and open fixed deposits branch wise. So if you have account, even online they used to allow. Some of the banks used to allow online. So you even if you have an account which say the Villepale branch or Andheri branch or the other branch, you can open account in Andhra Pradesh. Wherever you want to open, you can open a fixed deposit. On the maturity, the amounts get directly credited in your account. So the ADS was not getting deducted. That loophole has been plugged a few years ago. So now they are combining PAN number wise, so that is gone. So your interest can be more than what is reported in 26 years. showing interest less than what is there in 26 years, you need to have very good backup for that. Okay, why you want to show less? If the fixed deposit interest is very high, there are retiree people or who have very high fixed deposit and very high interest, the bank is going to take TDS only at the rate of 10%. If you are in a 20% or a 30% slab, you need to calculate the tax and pay accordingly, because of that the difference is payable. Another thing which get missed is for NCD and bonds held in demat form, usually the TDS is not deducted. So when you actually file your return, you will realize that this is the bond interest that I have got, and there is no TDS deduction. So at that point of time, you may have to pay the tax with interest. So it is better that before March you calculate what is the bond interest you have got, NCDs and bond, because fixed deposit interests were going down, so many people started investing in bonds and all. There is a separate calculation that you need to do, because if you have purchased the bond from the issuer, it's fine. If you have purchased from the market, then you need to calculate what is the imputed interest that you have paid there. It should be spread over and all. So that you need to calculate here. If you own a house property, that gets taxed on income from house property. If you own machinery or any other equipment, and if it is not your business, then you get taxed from income from other sources. So this and the expenses also are allowed here. So this you need to remember. Another, nowadays income tax refund, everyone is saying very fast. So if you get any income tax interest on income tax refund, that is fully taxable. So everybody must be getting that 143 one intimation in their emails. Go through that one intimation. It says interest under section 244A. That interest in the year in which you have received the refund is fully taxable. If you go through your form 26AS, it has one specific row for details of refund paid. That also shows what is the income tax paid and what is the refund paid, the interest paid. That interest you need to show as the income tax refund interest. Many people miss out, but if your case comes up for scrutiny or something, then he can add this to your income. This last one, April 2014 said this changes come. This was previously there was one section 51 in the capital gains. Many times it was misused also. That if you are having a say 1 crore house and somebody comes and say that I want to buy your house, and he pays you 10 lakh 15 lakh rupees as an advance token, and ultimately that house is not sold and you forfeit that amount. Earlier section 51 provided that that amount of 10 lakh 15 lakh rupees should be reduced from your cost of acquisition. In case the house is very old, many times the cost of acquisition will be very less. So that 10 lakh 50 lakh will be also quite a substantial amount. So what is to be done for that difference? One is you reduce, if the cost is 50 lakhs, you reduce 15 lakhs from that, your cost becomes 35 lakhs. Understandable. If your cost is 1 lakh and you have received 15 lakhs as the advance, then what is to be done for balance? Your cost becomes negative. There was a tribunal judgment which said that then it is a capital receipt and it is not taxable. So people started misusing as usual. So this has come. Any sum of money received as an advance or otherwise in course of negotiation for transfer of a capital asset. So it is not only about house, any other asset that you have. If such sum is forfeited and the negotiation do not result in transfer of such capital asset, from April 2019 onwards, it will be treated as your income. So you have to straight pay full tax on that, and your cost of acquisition will remain as it is. Now we'll go to some of the deductions which you can claim at the last moment. ATC, life insurance policy, as ma'am was saying, last moment life insurance. We always say this every year, but people say that don't make investment based on the availability of tax rebates. Make investment based on what is your risk profile, what you want to invest, what is your asset allocation. But every year we keep on repeating this. So say this. So life insurance policy, though it is easily available, many times not advisable to buy in March. But still, if you want to buy, ensure that the sum insured, that single premium policies usually don't buy. You don't get much exemption. Nowadays, the insurance companies have also become smart. They manage the premium in the manner that, they either reduce the term or do something so that this 10%, 15% limit is managed. Most of the policies are now compliant with this. The older policies may not be that much compliant. The newer policies are compliant. You can invest in ELSS, very simple, very fast. The mutual fund ELSS. You can subscribe to any deposit scheme for the public sector company or authority for providing housing in India. HUDCO has this scheme. So if you want to go for that scheme, you can invest. Payment of tuition fees for 2 children, excluding the development fees, donation or similar nature fees. So if you are paying this, you would have already paid. But if you are falling short, you need to consider how to take this in the entire ATC deduction. I don't think most of the schools don't allow so much advance payment, so you can pay next year, this year. But if you have already paid, you need to consider this. Repayment of housing loan for construction of property. This includes stamp duty, registration charges, but does not include any cost after taking of the possession. Here you need to remember that the construction of the house should get over in this current year. Then only you can claim this under ITC. If it not, then you cannot claim. 5-year fixed deposit with any bank. This is another very simple thing which you can do, or with the post office. But please remember, when you go to a bank, don't say that I want to make a 5-year fixed deposit. Please go and say that I want to make a tax saving fixed deposit. We have had few cases where people have made 5-year fixed deposit. They just went to the bank and say, over the phone you tell them that 5 years FD hai na, you have to make that. Or even if you tell them tax saving FD, they will go to the bank and say, 5 year only they will remember. They will not remember the word tax saving. So the bankers will make 5-year fixed deposit. When you come and see the fixed deposit receipt, it is not a tax saving FD. So not all 5 years FDs are allowed. These are specific 5-year tax saving FDs. So you need to ensure that you buy exactly that product. Payment for PPF, even if the PF is deducted from your salary, you can pay PPF. Even if you are not contributing anything to PPF, it is you have to pay some minimum 100 rupees amount, which you need to pay. Deposit, if you are a senior citizen, you can deposit the amount in the senior citizen schemes. So that is one more option that you have. ATC, there are certain where policies, insurance policy, PPF and ULIF. We need to understand the definition of relative. There are 3-4 definition of relative under section 80s only, so that chapter 6A. So for each section, please remember what is the definition of relative. So for ATC, your individual, spouse of that individual, children. For HUF, any member of the HUF. These are covered. Exceptions, parents, brothers, sisters are not included. This happens mainly in case of insurance policies. You pay some life insurance premium. If you pay mediclaim of your parent, it is allowed. If you pay life insurance premium of your parent, is not allowed. So this bifurcation, people many times are not able to, so they pay life insurance premium of their father from their account, and it will not get allowed. So please remember that. Go to 80D. Actually, it should have been very simple section, and if you read that section, it has become so complicated. So complicated. Many times it becomes difficult to understand what they actually want. A simple section allows a very small amount of deduction. Why it should be so complicated, I have never understood. But anyway, 1,50,000. I have never understood, but still it is there. I have tried to simplify it as much as possible. 25,000 insurance premium for yourself, 5,000 you can claim for preventive health checkup. This amount can be paid in cash, that amount cannot be paid in cash. 30,000 insurance premium for senior citizen or very senior citizen. For very senior citizen, there is another option. If he doesn't get any insurance policy, if you have done 30,000 of medical expenses for very senior citizen, it would be allowed. So overall limit for 1670 is 60,000 for individual and 30,000 for HUF. So 30,000 here, 30,000 here. Still it is complicated? No, no? Okay. Not understood.
How 60,000? Yeah, last.
30,000 for yourself here, and if you pay 30,000 insurance for your parent or somebody who is senior citizen or very senior citizen, or you incur 30,000 expenses.
I pay for my parents.
Yeah, you pay for your parents. So ATC it is not eligible. So if you insure their life, it is not eligible. If you insure their medical, it is eligible. Why? I don't know.
It's a family plan. How does it work out?
Family floater plan. Very difficult to calculate. If your parents are included in this, it is allowed. If it is LIP, it is not allowed. If family floater plan, you will have what? Your family, your parents, so it will be allowed.
The first bracket or the third bracket?
Whether there is anybody who is a senior citizen or a very senior citizen, then you will be going to the higher slab, otherwise you will go under the lower slab. Ideally, this should have been very simple. This is the amount allowed, done with it. But again, definition of relative, individual, spouse of the individual, dependent children. There you have said children. Here you are saying dependent children. So if it is what is dependent, independent, not defined, but dependent children. Parents included, brothers and sisters not included. So you can still not do anything for pay premium for brother or sister. Next is 80 DDB. Eligibility is individual and HF. You are allowed medical treatment of expenses. Who all are allowed here? Assessee, so that individual, spouse, children are allowed, parents are allowed, brothers, sisters are also allowed. Okay. And what is the amount which is allowed? So this year onward, there is some change in the amount also. So we'll go through that. Medical treatment expenses, self, spouse, children, brother, sister, who are not seniors or very senior citizen, maximum deduction is 40,000. Dependent or assessees, if they are senior citizen, the deduction is 60,000. Or they are very senior citizen, the deduction is 80,000 rupees. So what all can be, they have specified what all can be allowed. Dementia, dystonia, muscular deformers, motor eczema, cholera, lot of Parkinson disease. I don't know what it is. Some doctor is there. He can tell what it is. I will. All neurological. They have certified by a neurologist. Previously, you had to go to a government hospital to get this certificate. Now they have changed that you can go to any certified neurologist to get this. Cancers certified by oncologists, AIDS, nephrology to any urological, hemophilia, thalassemia. Deduction amount will be reduced by any insurance money that you get. So obvious, you cannot get both. If you are claiming an insurance, this will not be allowed. This helps many times if you have this kind of specified diseases and you can obtain some certificate from your doctor, you can claim it as a deduction. Next one, 80G. I have only included which is 100% allowed. What is 50% usually comes with a cashback clause, so I have not included that. Only 100% which is included here. So there are many funds. I have included only few of them. A huge list of funds where you can pay 100%. It is allowed. You can save tax.
Is there a limit?
Sorry, this there is no limit. For that 50% there is 10% of gross total income minus whatever is it.
To pay and not pay.
So it is as good as these are mostly government funds. Okay, if you read the National Defense Fund, Jawaharlal Nehru Memorial Fund, Prime Minister Drought Relief Fund, Prime Minister National Relief Fund, National Children's Fund, Indira Gandhi Memorial Trust, Rajiv Gandhi Foundation, Swachh Bharat Course, National Sports Fund, National Cultural Fund. There are many more. I have not included all of them.
I think there are some private also.
Sorry?
Some private are there, Akshay Patra and all that.
Some very few are there. No, it's not here. I have not included it here. I don't know how many people contribute to a political party.
I just read today that some of these, which I think 39A or something, right? The government is cancelling many of these 100% deductions to NGOs. Not the government ones, so those will remain. But a lot of the private ones, I think people who work with mental disorder and some scientific and education institutions also have had 100. So some of those private ones are cancelling the 100% deduction.
Scientific institution not under 80G, that is different again.
No, not 80G, the 100% deduction, which is I think 39A if I'm not mistaken.
35, section 35.
35.
The 35AC.
35AC.
They are deducting, nowadays this government is...
That may be for the next financial year.
Yeah, it'll be for the next. I just read in today's paper, it's not happened as yet.
It will be applicable from the date on which it is actually removed. So we...
For this
Yeah. No, this you can do it for this year also. No? The year is still not over. So before March you can still do it. There is no problem. 80CCD, I think now everyone knows. Pension scheme, additional 50,000 above that 1,50,000 limit. You can invest. and from 15-16 onward this scheme is available. Some of the features of the scheme have been changed recently, where you can change the fund manager or you can change the scheme allocation. There are two features, auto allocation, and you can allocate on your own. So you can opt for any of these schemes if you want to invest.
Sir, I started investing in NPS from this year, thinking that I would be able to claim in 80CCD 1B. But I came across a case by one tax consultant where they said that you have to claim it from 80CCD 2D first through your employer. Well, first that has to be exhausted and then 1B, 80CCD 1B can be claimed. Is it true or?
No, I don't think so.
They are both independent?
Both are independent.
Okay, thank you.
But the overall limit and all for employees, there is 10% of the salary and all those limits are there. We'll go to some of the tips for tax filing. Return for financial year 2014-15 cannot be filed beyond March. So if you have still not filed for financial year 14-15, you need to file before March 2017. Otherwise, it will become time barred. And now they have all the information in the AR info. So you'll get a notice after March that you have not filed the return, and they may ask you to file, and there will be all consequences. So if you have missed filing for 14-15, better to file it before March. Next year onwards, it is very important to file your return on due date. If you file it after due date, there is a 1,000 rupees, 5,000 rupees or 10,000 rupees fee, and this fee is automatic. So if you are late, that fee becomes automatic. Another change which has come now is section 269 ST. Any cash transaction of more than 3 lakhs is not allowed. If you do any cash transaction of more than 3 lakhs, buying, selling anything, then the penalty is equivalent of the amount. April. So if you do 3 lakh and more, then the penalty amount is equivalent of the transaction value that you have done. So any amount transaction more than 3 lakhs. Another thing which is going to change from the next year onwards is time limit for filing the revised return. Previously, the time limit for filing the revised return was 1 year from the end of the assessment year. So if you have already filed this return for the assessment year 16-17, so you could file revised return up to March 2018. So you get 1 year to file. They have removed that 1 year. Now revised return can be only filed within that assessment year only. So basically, they want to complete everything in that assessment year. All return filing, everything should complete in that assessment year. Then you move on to the next assessment year. I think in a way it is good also, because otherwise the assessment used to drag for years and years and years. So that is good. Any questions?
The cash at hand, if you have got in your account, then the 3 lakhs is applicable.
Please wait.
If you have in your books of account cash at hand, then this 3 lakhs is applicable how?
This is applicable in case of you do any transaction. Cash on hand, you can have anything. It is not dependent on the cash on hand.
Now, in the case of employees who are retired and whatever benefits I've received, that is gratuity or retirement, that money is in the account put in FD. Okay. Now, is that amount taxable if that FD is renewed after whatever period?
Yes.
It is taxable.
That amount, the principal amount of fixed deposit is not taxable.
Okay.
The interest that you have earned on is taxable.
That is taxable.
In case of a cumulative FD also, on the date of maturity, whatever is that amount will become taxable. And if the amount is high, bank will calculate the notional interest or it is not notional, actual accrued interest up to March. They will deduct tax and pay and show that amount that you have earned so much interest.
Okay. Thank you.
I came across a case where the person had a transferable job, and he was mostly investing in PPF. Now, some time back, they had said for 25 years only or 15 years. And at that point of time, he was elsewhere. And when the bank to whom where he invests said, no, you cannot extend it, he opened another account. And since he was busy, that account remained What happens in such cases? Now he's been only investing in this, and when the bank advised him that you have not paid for, he paid some 1,000 rupees or something like that and restarted that account only, but he was not making any claims on that, tax-wise. So what happens in such cases?
As I understand the PPF rules, you cannot have two PPF accounts.
So what happens to them?
No, I think
it was a genuine case.
No, see, the issue in such cases is not whether it is genuine or not, whether it is allowed or it is not allowed.
So what happens?
So I think what they usually many times do is in one of the account you will not get the interest. The amount, principal amount will be paid to you.
Interest will not be given.
Interest will not be paid. As per law, as I understand, PPF law, you cannot have two PPF accounts. You can have only one. Okay. Even when you are depositing, as I understand, in your children's account, that limit is also counted with you. So if you are depositing money in the your minor child's account, that limit is also counted with you.
Okay, that's all okay. Only the interest will not be given, is it?
The principal they will not take away.
Okay.
Sir, I have a request. Can you say this late fees, 1,000, 5,000 and 10,000? Who 1,000 is applicable to whom and 5,000? Please, can you?
Yeah, okay.
Thanks.
Income up to 5 lakh rupees, they are saying fees is 1,000 rupees if you file late. For 5,000 and 10,000, if you file by December, it is 5,000. If you file beyond December, it is 10,000.
Yeah. This NPS, there is two things. One is equity, that's tier 1, equity and debt. So suppose somebody invests in equity, in debt, and then on maturity, any long-term benefits he gets or what? Besides that 40%?
No, see, taxability at the time of withdrawal is a separate subject altogether. It's going under a lot of change, and this has come recently. So withdrawal taxability is not even this thing. NPS withdrawal, you have to compulsorily buy an annuity, balance period will not be allowed to you. So it's a separate subject altogether.
My wife, she is not working at the moment. So can I claim her LIC policy under my tax exemption?
Yes, you can. But you have to pay from your bank account.
I have to pay from my bank account.
If there is an automated ECS, then you'll have a problem.
But the LIC doesn't allow to pay online if you're not the account holder of like that.
That insurance company wise, I'll tell you what is there in income tax.
They have that online. You have to certify it's your own.
You can register multiple bank accounts. I don't think the law allows, why LIC will not allow.
No, you have to, it asks you whether it's your own account, specifically on LIC side. Sorry. Do you have a question?
If there is no taxable income, still the late fees are applicable?
Up to 5 lakhs they have said, no?
If the taxable limit is a 2.5 lakhs.
But then you are not supposed to file that return. Why you want to file?
There is no need to, but before he was filing the return. At that time he had income of say 3 lakhs or 4 lakhs. But now if it is 2.5, so he should not file the return?
If your income is below taxable in a particular year, and then there is no need for you to file the income tax return.
Okay.
But if you file, then you have to pay.
If you file, then you will have to pay. Anything? We'll go to this rule 114E now. This is changed and a lot of information goes. If you have done any of these transactions, then please ensure that you file your return, whether you have income or not. Because if you have done these transactions, and if you don't file your return, you can 100% assured that you will get an income tax notice saying that why you have not filed. So we'll go through this transaction. Fixed deposits of more than rupees 10 lakh with the same bank in a year. So it is HDFC, ICICI, Axis. If you make more than 10 lakhs of fixed deposit in a year, compulsorily you should file your return. Cash purchase of demand draft from more than 10 lakh in a year. Banks nowadays not allow you to buy more than 20,000 rupees cash demand drafts. But if you have managed and you have brought, then if you have given your PAN number, it will get reported. cash deposits or withdrawals of rupees more than 10 lakh in savings account or more than 50 lakh in a current account. So if you cash deposit 10 lakh, understood. If you have a large salary and you are withdrawing cash very often from your bank, if you withdraw more than 10 lakhs in a year, it will get reported. Whether you will be added, it will added to your income or not, it's a different thing. It will get reported. You should file your return and be ready with the explanation. Payment of credit card more than rupees 1 lakh in cash or more than 10 lakh by any other mode in aggregate. So if you own a credit card and you swipe very often, if you have made any large purchases in a year, if you made more than 10 lakh rupees purchase through a single credit card, it will get reported to the government and they may come and ask you the question. Buying of bond, debentures, application to IPOs of more than rupees 10 lakhs. And please remember here, the limit is for application, not for allotment. So many times in IPOs, you know that you will not get allotment, so make a very high application and then the allotment levels are low. So, but this gets reported based on the application. Tendering of shares. Tendering of shares in buyback of more than rupees 10 lakhs. If there is any company, this is not applicable when you sell the shares in the market. And if the company is buying from the market, they will not know who is from whom they have bought the shares. But if there is a buyback offer specifically from the company and you have subscribed to that, if you have offered shares worth more than 10 lakh rupees, it will get reported to the income tax authorities. Investment in any scheme of a mutual fund company for more than 10 lakhs, excluding switch-ins. And this limit is not mutual fund scheme wise, this is mutual fund wise. So if you have, say, in a particular mutual fund, if you are investing in a liquid scheme also, in an equity scheme also, in a debt scheme also, they will combine everything. Previous limit was 2 lakhs. That was interpreted by people as per scheme. And mutual funds also many times used to report it that way. Now the limit is increased from 2 lakhs to 10 lakhs, but this is now fund-wise, not scheme-wise. So you have to see whether in each mutual fund you are investing more than 10 lakhs. This happens many times when you withdraw and invest. Even if you are not investing more than 10 lakhs in a year, but if you have withdrawn some large amount from mutual fund and invested again, in case of switch in within mutual fund, this limit is not considered. So that is not considered. Buying of foreign currency or traveler checks more than 10 lakh rupees. If you are going abroad and buying foreign currency of more than 10 lakh rupees, this will again get reported. Purchase or sale of immovable property for more than rupees 30 lakhs. If you buy or sell, that limit of TDS of 1% is separate. This, when you register your property, the registrar is supposed to inform. In all these cases, you are not supposed to inform to the government. The concerned agency with whom you are dealing, they will go and inform. They will take your PAN number and they will go and inform. So if you buy or sell more than 30 lakhs property, both sides get reported. Cash purchase about 2 lakh from anyone, they will ask your PAN number and report it. Okay. We'll again, this is another section. Nowadays many people are receiving notices and they go there and attend. Please read this section before you attend any notice. When an SCSE has appeared in any proceedings or cooperated in an assessment, it shall be deemed that any notice which is required to be served upon him has been duly served upon him, and such assessee shall be precluded from taking any objection in any proceedings in an inquiry issue that cannot be raised. You are precluded from, if you cooperate in, if you are issued a notice, go to the income tax officer and cooperate with him, then you are precluded from saying what? Issues that cannot be raised. Notice was not served on you, or was improperly served, or was not served within the prescribed time. For every notice that is issued in income tax, there is some prescribed time, some manner of issuing those notices, the way it should be served. There are many case laws which were happening where only on this ground the assessments were held to be null and void. So they may issue a notice, you may cooperate, they will find a lot of things, you will go to Commissioner of Appeals or tribunal and say that this notice was wrongly issued, and say if it's an assessment done qua wrong issued notice is not an assessment, so the assessment were to be held as null and void. The law has been changed, and this is changed in 2008. Okay, it's not the recent law. Though many people were not aware. Some of the case laws pertaining to this law started coming for diluting this, but the law it stands today. Only caveat that they have given is if the objection was raised before the completion of assessment. So when you go for an assessment with the income tax officer, at that point of time you say in writing, not verbal, you say in writing that this notice was wrongly served on me, not served on me, or was not served in time. If you have raised that objection at that point of time, then you can still cooperate and raise this issue at the higher level, saying that this assessment is null and void. Otherwise, you are precluded from saying this. Yes.
So the notice is normally sent by what? Post, mail, or email? What? How? Are there any norms?
Various ways in there which they are sending. The laws are also changing. Now the email notices are also recognized. There is 143.2, that is scrutiny. The notices are now issued on email also, your registered email ID. So that is also a valid notice. Notices are physically also served on you. See, in income tax, there are various sections in which we know only scrutiny, but there are various sections. In each section, there is a specific manner in which the notice is to be issued, specific approvals you need to take before issuing such notices, the manner in which those notices need to be served. There are some section in which the notice is to be served on you before a particular time. Some section in which the notice has to be issued before a particular time. So issuing, serving, everything has a manner. And when the cases used to go to courts and people say the notice was not served properly, so court say I don't have a choice. Your entire assessment proceeding is wrong. It is null and void. So that is they have covered now.
Yeah, in the previous slide you had for credit card of 1 lakh cash payment and 10 lakhs. That's what I do generally, pay it online. But in case of a foreign bank with a foreign debit card or a foreign credit card, that would not be reported by them, but it would be reflected when you you report your foreign bank.
Foreign bank, I didn't get.
A bank abroad. You have an account in a bank abroad, right? Which you had mentioned in the first couple of slides.
Okay.
You have
that card you are using in India.
Yes, because it's still active, right? It's a debit card.
But the amounts get debited in foreign currency or
in the foreign currency when I buy something online.
Okay.
So, but that will show up in my bank statement, the foreign bank statement. So that doesn't apply to...
That will not apply here because the law doesn't apply to the foreign bank.
Right.
But in your income tax return, there is a separate section of foreign assets and liabilities.
Okay.
There you need to report this bank account as well as the credit card.
Any transactions which were made in that.
You will need to report it there.
Okay. Thank you.
In the same previous slide, you mentioned about foreign currency during travel. Now, what is the limit to which we can exchange for foreign currency while traveling abroad?
This is the reporting requirement. There is a separate PIMA requirement, what you can buy and what you cannot buy. If you buy more than 10 lakhs from a bank, that will get reported.
Okay, if it is just less than, then it's no problem. We don't have to
In income
report.
tax, you will not have a problem.
We won't have a problem.
Yes.
Thank you.
This is changed from the current year.
Excuse me, what about this clubbing of income with regard to spouse? In that interest income or fixed deposit or bank savings account, clubbing of income with regard to spouse.
See, if you have transferred any asset to your spouse, then whatever income that gets generated out of that asset will get clubbed to your, because it is transferred without consideration. Now, any income generated out of that income will not get clubbed. I'm clear or?
Yeah, I wanted to ask specifically about bonus stripping for offsetting short-term capital gain. If I don't hold the asset for the equity shares for less than 3 months, is that okay?
Section for that. There is a separate. We have not included here because there is a separate section for bonus stripping. How long you should hold? What is the dividend amount? What is the loss amount? How it should be calculated? There is a detailed calculations given.
Different chartered accountants have given me different opinions. Some say that the 3 months holding is required. Some say it's not required.
So that is what I'm saying.
No, but some say it is not required. So it seems to be ambiguous.
No, it is not ambiguous. It is provided under the law and it is very clear.
For bonus stripping?
Yeah, for bonus stripping.
No, I'm talking about bonus stripping, not dividend.
Bonus stripping, dividend stripping, both.
So I buy a bond which has it's a long-term bond. but then inbuilt there is a interest which is given at the end of the tenure. And I buy it or I get it initially. At the end of the time, I get the full amount, which includes that interest amount plus the principal. Can I take it as a long-term tax gain? Is it an interest gain?
Sir, in case of such bonds, which is either deep discount bonds or bond with a maturity value, you have to see that scheme under which they are issued. Exactly what it is. Because then if it is a deep discount bond, then you can treat it as a capital gain. There is an option, or you can compute the interest if it is a cumulative bond. So exactly what is the issue?
No, cumulative bond.
Then it is interest. If it is a cumulative bond, then it is an interest. If it's a deep discount bond, then it's a different thing. So simple bond is not the issue. What is the scheme? How it is issued?
But suppose I buy it from a company and sell it in the market.
Then it's a capital gain. Then it's a capital gain. Then it's a capital gain.
Okay. And suppose I buy it from a market, and at the end of the time, company gives me the determined amount. Then
it will depend on what price you have bought and what is that bond.
No, but then capital gain, it's the interest.
It will be both.
Okay, it will be both.
That is what I'm saying. It depends on the bond, and there is always some imputed interest when you buy it from the market.
Major is interest, and minor is that either loss or a gain.
So it depends on bond to bond. I cannot give you a one-liner saying that if you buy a bond, sell, this is what will happen.
So it's better to sell it in a market.
I cannot say that, sir. I cannot say that.
To take it as a long-term gain.
I cannot say that.
Okay.
3 years. You have to hold it for 3 years.
No, I'm telling that
long-term
bond
capital gain,
which I buy it in a market, it might get matured after say 8 years. I'm holding it for 8 years, which I bought it from a market, but then it's a cumulative interest bond terminology. Then how do I take
but
the gain?
But you're getting any interest or you're not getting any interest?
I'm not getting. At the end of the term, I will get the full amount.
Then it will be interest. No? It is an interest.
It will be interest.
Yeah. So this is another change which is applicable. Everyone who is filing the return, you must be getting an email saying that intimation under section 143(1), and it will give a computation, the file which is protected by a password, and it says, it gives particulars, it gives what you have filed and what they have considered. So you can compare what you have filed and what they have considered, whether ultimately there is any refund payable to you or whether there is any tax payable by you and what is the interest. This was a very simple calculation which they used to do, and whatever the 143(1) intimation was, whatever you have filed, with some basic calculation they will do. This year onward is a test change. It has now become like a mini scrutiny. I would say pre-scrutiny. Yes, scrutiny is 143(2). This is like a pre-scrutiny to a scrutiny. So what all they can change, and what all, and this will be done by CPC Bangalore, not by your assessing officer. So you'll get an email. So mostly people used to ignore that 143(1) intimation. If there is refund, they will go through it, whether the refund has come or not. If there was some tax payable, you may ignore, or it's okay. But now when you get that intimation, you have to see, and this will be done before processing of that intimation. So it's like a quasi scrutiny powers. And what all they can change? Wrong carry forward of loss. So if you have filed a previous year return late, and the loss is not allowed to you for carry forward, because in case of a loss return, you have to file the return in time. If the return is filed late, then the loss carry forward is not allowed. So now the CPC is allowed to not allow you that loss, and they will check from your past records whether this carry forward loss is allowed or it is not allowed. Disallowance of expenditure in audit report, but not taken in computation of income. This is very controversial according to me. So what happens in case of an audit assesses, business income assesses, the auditors write something in their audit report, that is the tax audit report, saying that so-and-so expenditure is not allowable. They many times write in the notes also, saying that this expenditure assessee is claiming to be allowable based on so-and-so decisions. But auditor cannot say that you should claim it. So auditor will say this is not allowable. However, the assessee is claiming beneficiary so-and-so, so-and-so. And the assessee never used to disallow those expenditure. If it comes for scrutiny, then they will fight it there. but in the return they will claim those expenses or whatever. So now they are saying something which is disallowed in the audit report, the CPC will write you saying that I want to disallow it. How it will happen, whether this then these orders will become appealable. As such it was appealable, but the CPC orders will become appealable because I have taken a view. Now that view needs to be judicially checked whether it is right, not right, whether I am right or the government is right. Additional income, another very controversial. Additional income appearing in Form 26AS, which is not included in the return while filing the return. In some cases, they will be able to identify, but in some cases, how they will identify, I am still not very clear.
How this can happen?
Sorry?
How this can happen?
No, this happens. It happens, say you are following accrual system of accounting, I am following cash system of accounting. You are in March, you are supposed to pay me something which you have not paid, but you will deduct tax on that and report it in March 2017. You will pay this money in April. So I will declare it my income as 17-18. You will declare as your income in 16-17. This can happen. Many times interest you want to income from other sources, the banks are reporting based on the accrual system of accounting. If you are following cash system of accounting, then you will report interest as and when you get it. So there can be cases where people will report it in a different manner. Disallowance of the deductions made. So if you have made any deductions, you have claimed any deductions, they are allowed to claim it, saying that, but the only good thing is opportunity of being heard will be given before making these adjustments. So as I have said, this has become like a mini scrutiny. They will issue you on the notice, you are supposed to reply online, and based on your reply they will compute whatever they want to compute, and then they will issue you a final thing saying that this is your 143(1) intimation. We are done now. Anybody?
The disallowance of deductions made that you are pointing out, this will arise only when there is an assessment.
So this is like apparently I feel that you should not be allowed.
The CPC, by looking at the reported
income tax ITR return, they will say that this should not be allowed.
But the returns have all broad heads.
Broad heads.
Even then,
in case of audits, the audit report and everything we are scanning and uploading. So they may check from that. Or they may apparently say that you are not allowed this deduction.
Or the audit could happen later, and your income tax, suppose I file a return in April, and my audit happens in June, so there's no audit report.
No, if you are covered under tax audit report, then you
are talking of tax audit.
Tax audit report, yeah.
As a professional, when I'm getting my income, from my client, then is there a limit where I have to cut 10% TDS?
No,
what is the status?
You are getting the income, you don't have to cut TDS, no? That the client will deduct.
Yeah, so at that end, is there any particular figure or something?
Yeah, if it is a professional fees, there is 30,000 limit, na? Under 194J.
30,000.
30,000 rupees limit. For the full year, huh?
Of that party, one party for one full year.
One full year.
Somewhere in the beginning, you had made a point about having, salaries from two different employers and, not deducting tax. So on that thing, I want to say that suppose in the last month, can I for any reason tell my employer to deduct more tax, and is there any limit on how much
You can do that.
I can ask them to deduct my entire salary?
Yes, you can do that.
So will that help me in saving, whatever interest on the advance tax?
It will help you in saving.
Okay.
That is why I said it is better to ask your employer to deduct additional tax rather than you paying advance tax.
Oh, that's good.
So you will save under 230%, you will save interest.
And just there's one point I'm making, that in PPF they're talking about two accounts. Now I think when you open an account, you give an undertaking that you don't have any other account.
Yes.
You're supposed to give that undertaking for PPF
That
now.
was previously also there.
Okay. Older forms, it's not there.
It was always, I think this rule is there for many years now, that you cannot...
No, rule is there, but that undertaking was not included in the account opening form, Form A.
I have not opened a PPF account. That's why I don't know.
I have a question about...
I have only one, so I don't know what will happen if I go second one.
I have a question about business income.
You can say.
Okay, for deduction related to expenses, are all expenses which are available to companies allowed to be deducted as in individuals?
Any expenses for the purpose of business, which is you incur in the normal course of business, that will be allowed.
So one doesn't have to start a company to get those expense deductions?
No, I didn't get, sir.
Give example.
Okay, if an individual has business income, is it more tax efficient for him to start a company and claim those expenses?
There is no need. You can have, as an individual, you can claim, if you have business income, you can claim whatever expenses there for your business.
Okay.
There is no need.
And nowadays, the banks have got the UCIC system through which, even if you open a PPF account, they can match with that and easily identify you already have an account.
They can do that. So,
sir, my question is regarding health insurance deduction allowed. You said 30,000 in the case of senior citizens. Parents. So if the parents are not senior citizens, I mean below the age of 60, what is the amount in that?
Then you go under the earlier slab, no, for 25,000 rupees.
25,000.
Yeah. That additional amounts is only because if you are a senior citizen or a very senior citizen.
Okay, fine. Yeah, understood. Thank you.
As I have said, 80D should have been very simple. If you actually go through that section, it is so complicated.
So 25 in case of a normal family, and if there is a senior citizen or parents, then additional 30,000.
Yeah.
Okay, thank you.
For small amounts, it is far too complicated.
This is regarding capital gains. Suppose we buy the flat, and which year you have to take into account. The thing is, agreement signed in a particular year, but we start payment 2 or 3 years before. Which is the date of purchase?
In case of buying of a residential property, yeah.
We sign the agreement after maybe 2 years, and possession maybe after 4 years. So which is the year?
You want to know the date of acquisition?
Yeah, date of acquisition.
Date of acquisition will be the date of allotment letter that you get from the builder.
The date of allotment, but payment will start step by step. So
that is usually construction linked.
Yeah,
payment,
construction linked.
Construction payment. So the date of the allotment letter.
Okay, another question regarding a flat purchase in the son and mother's name, and first name is son's name, second name is mother. The rent received by mother, so whose account it will be?
It is on the basis of the contribution made by both of them. Who has contributed how much to that flat?
Irrespective of who receives the rent?
Yes.
Okay, thank you very much.
I have Mediclaim facilities from 2 different insurers, and both of the receipts are being generated by me in my name, and it is a family plan. My wife, who is also a working woman, can she avail the benefit of it? Because there is a 25,000 limit, and
she has paid from her account, she can claim.
So, if she pays from her account, although even if the receipt is generated in my name, that should be fine.
That is an issue which happens with the insurance companies, because you must be a proposer. And if somebody else pays, the receipts get generated in some other person's name. That is an issue which is there. But as far as income tax is concerned, as long as it is paid from your account, you will get the deduction. That is what I believe. There is a difference of opinion on this, but I believe that if you have paid from your account, you should get it.
Okay, fine.
In case of business income by the proprietor, can he claim the car expenses, petrol expenses, mobile bills?
Yes, he can claim.
1/5 is allowed only?
See, if your case comes up for assessment, then he may say what is a part of that used for personal purposes, how many, then there is some rule which says that you have to maintain a logbook for the car. So
it's better to claim 1/5?
So you have to, if you claim something which is reasonable, it will usually get allowed.
I have opened a PPF in my son account when he was a minor. Now, up to how many years he can contribute to, means how many years that account is valid? 15 years?
The
Yeah,
validity is same. Now I think extensions are allowed, and when he becomes a major, then he has to get that account converted. No?
He has to convert it.
You cannot keep. No, how can you keep?
No, but he after major, how many years he or she can contribute in that?
I think now the extensions are allowed. As far as I know, extension every 5 years you have to extend it for another 5 years.
Lifelong. Okay.
Sir, in the case of senior citizens, when there is no income, there is no filing of returns. But there's a TDS on their FDs. So which form to be filled for getting returns on that TDS which has been
There is no
deducted?
other income except for the income from FD, then ITR 1.
ITR 1.
ITR 1.
And supposing this has happened couple of years back, can it be refunded?
As I said, 2014-15 you can file. Financial year 2014-15. Prior to that, you will not be able to file.
Okay. Thank you.
For medical policy renewal, at the time of renewal, if you want your spouse name to be first, you can change it at time of renewal.
Yes, but see,
And then she can take a tax
people pay,
benefit.
1 year I'll pay, 1 year somebody else will pay.
Every year it can be changed.
Depending every year.
Yeah.
So at the time of renewal, you should be sure. What
Yeah.
should be done. Yes.
Nikhil, thank you once again for a very, very comprehensive session. And thank you so much for taking time even to answer the helpline queries. And I have a request. If you have questions, you can ask them on the helpline. Nikhil Vadia and a couple of others are generous enough with their time to give advice. However, we really request that don't use this free service instead of going to a professional. If it's very complicated and business related, we don't entertain that. If it's personal, that they're very generous with their time and they're giving you free advice. As long as it lasts and as long as we are able to run it, make the best use of it. Thank you so much.
Thank you.